understand like how the Fed operates, understand what interest rates do to all of the markets. Can't emphasize this enough. And, one of the guys that I used to work for before is writing a book on it, like really, really take into account technological risk. And he always used an example of like a taxi medallion. Like in 2000 and something, taxi medallions were like worth hundreds of thousands of dollars. It was like the only way for you to get from point A to point B without your own personal vehicle. And then all of a sudden, Uber came along and taxi medallions were worth nothing. So understanding where technology is going and how that's going to affect real estate, how that's going to affect the products that you use every day, the companies that you're investing in, I feel like that's something that's very commonly overlooked.
Welcome, everybody, to a new episode. Making sound investments is just as important as making an accurate diagnosis. But today's financial markets can leave even seasoned physicians feeling a little bit uneasy. So today we sit down with Chris Parinello, Viking Capital's Director of Investor Relations. Welcome, Chris.
Thanks, Nathan. Happy to be here.
Awesome. We're going to discuss, practical tips for your portfolio. We'll break down key investing concepts like assessing risk, proper diversification, and finding stability amidst volatility. Whether you're just starting out or you've managed your investments for a long time, we're going to review core concepts, emerging trends, and pro tips that bring you clarity and confidence. So let's dive into it. Chris, could you give us kind of a brief background as to your experience in finance and investing?
Yeah, absolutely. My background in finance and investing started at a pretty young age. My dad, I think I was 7 or 8 years old, and he pulled me aside and he was like, "You know what, Christopher, I'm going to teach you about the rule of 72." He's like, and in fact, it's the eighth wonder of the world. And I didn't really grasp it then, but like as I grew up, it basically teaches you, if you haven't heard of it, it teaches you the miracle of compound interest and how that will grow over time, which is, I think the bedrock for investing. As I, went to college and, my dad and I worked on investing in stocks and things like that when he was still alive, that was my next foray. And then I started my career, working in China with a real estate firm and kind of understanding from a high net worth Chinese individual who had just gotten her green card through the EB-5 program and who was taking the money that she had generated through a factory that her family had managed and was buying assets all over the world, a vineyard in Italy, properties in Queens, in New York, and kind of taking those same principles that my dad was trying to teach me as a kid and trying to preserve wealth. That was the stage in her investing journey that she was in. Moving on in my career, I was developing hotels, helping other high net worth foreign investors get green cards and also protect their wealth through hotel development in Southern California. So I have a pretty diverse real estate, specifically investment background. I'm happy to share any of the tips and tricks that I've learned along the way with you today.
Yeah. Absolutely. And you do a great job of talking with investors pretty much on the daily, morning, afternoon, sometimes even nights, weekends. What kind of sparked like the initial kind of change from, being taught about finance and investing to really kind of teaching others about investing and real estate?
Yeah, this is a really clear moment in my career where I realized I had become the teacher and not the student. So when I took on that role in Southern California, a little bit of backstory, the EB-5 program is something that's been around for a while. It's sunset, now it's back. But you basically have a bunch of foreign investors who are in investing, and their main purpose of investing is to create jobs in America. And for doing that, they are given a green card and eventually can get permanent residency status in the US. There's programs like this all over the world for different countries. That's the US program. So in that role, I realized very early on that these people did not focus on the investment at all. They were focused on getting a green card. But what ends up happening when people aren't focused on the investment is they make bad choices and they put their money into bad things because they're not looking at the finer details. So in that moment, with my conscious and moral compass, I told myself, I was like, I have to force these people into looking at the investment. And as the EB-5 program went on, groups like the one I worked for did really well, did a lot of deals, people got their green cards. Folks that invested with smaller regional centers that didn't stress, the modeling and how things actually work, you had a lot of people that got their green card and lost all their money or didn't get their green card at all. So that was the moment where I feel like as someone that is in any way, shape, or form selling an investment or working in investment sales has to pinpoint where the investor's sophistication level and education is and meet them up to where they fully understand what they're doing, what the risk is, and how it can impact their lives.
Yeah, that's a great point. Have taught and coached, a ton of physicians and kind of other, high net worth individuals how to, do multifamily and do real estate. And at the beginning, I was very much under the impression, let me give them everything under the sun, every single detail, every, acronym I could imagine. And I got some feedback that it was like rocket science. Like I know that you know your stuff, but I have no idea what you're talking about, right? And kind of finding that middle ground where you can actually translate what you know in a simplified but understandable format, I think is one of the best ways to kind of talk about, investing in general.
That's it.
There are so many different kinds of investments that you could go down, right? You can go gold, crypto, real estate, alternative assets, small businesses. What are some of the core principles that investors should focus on when building their portfolio?
Yeah, I would say, depending on one big rule, and I think that everyone should follow this, is you shouldn't invest in things that you don't understand. So that should be your foundation. If you want to invest in real estate, or you want to invest in crypto, or you want to invest in traditional equities like stocks and bonds, spend the time, go get the books, read it, find a mentor, do what you need to do to where you can understand what needs to happen for it to go right and what could happen if it goes wrong and how to protect yourself. So that's always going to be the foundation. Once you have that, I think, the folks that I know, myself, I think you always want to have some exposure to traditional equities, stocks, bonds, mutual funds, ETFs, things like that. But you want to keep in mind that everything that you're investing in is going to operate cyclically. And there's going to be good times to buy and bad times to buy. So that's really what you want to keep in mind. We're going to cover a lot of this stuff in here, but I think that just covering the asset types that I have in my own personal portfolio and that I think everyone should have is traditional equities, stocks, mutual funds, bonds. I'd add in there alternatives, especially real estate, and that's active and passive real estate. And then I think that as you look at the risk reward spectrum, venture capital, if you have, good contacts, you can find good opportunities, Bitcoin, things like that. There is a case to be made that you should take some big swings. You just need to make sure that you're balancing out and finding harmony with the risk adjusted, stable investments that you're making.
Yep. No, it's 100% true. And I think one of the other, core principles is capital preservation, is to not lose capital. Ultimately, if you start losing capital, it becomes more of a liability than it does an asset. And you want to invest in assets, not liabilities, right?
That's right.
So you talked about, risk a lot. I think it's also another, core principle, or at least kind of a core skill that you should learn is, how to value risk and reward. I think a lot of people focus on kind of the reward and the profit side and the upside of a lot of investments, but they don't really pay attention to the potential risk. Can you walk through the different kinds of risks that investor may face as they're, building their portfolio?
Yeah, I mean, I think that, the risk spectrum is pretty easy to define. You're going to make money or you're going to lose money. And the opposite end is you make, however infinite amount you can make, and you could also lose everything. So when you're evaluating risk and you're developing your portfolio, you're trying to find investments and fully understand what would happen for this to be a grand slam and what would happen for this to be, a total loss. What ends up happening and where most investors, I think, finally find a sweet spot is let me invest in something that's going to be a single that could grow to a double or a triple or a grand slam. I want to protect my downside risk. And if I'm investing in something that maybe 1 in 10 investments, I could lose, then you're in good shape. Because ultimately what you're doing is, there's a lot of parallels to investing to gambling. And you're making a bet on a sponsor or on a company or on the US government when it comes to treasuries that you are going to get paid back and paid back with interest.
Yep. That's really your point. And for me, it's always, when I'm doing investments, I always think of, hey, what's the worst possible case scenario, right? What's kind of the greatest risk? Is it losing capital? Is there kind of a recourse loan potentially, right? But if my greatest risk is I lose all my capital, and then I compare that with the potential upside, even kind of, best case, most likely case, or even kind of slightly upside case, I think there's an argument to be made that, if you feel comfortable as kind of a gut reaction, losing all your capital for that potential upside, that's kind of your initial kind of gut check for your risk tolerance. And I think what's also important to note is that not all investments perform equally, right? You can say like you're investing in stocks, but not all stocks perform equally. People make a ton of money with stocks and people lose a lot of money. Same thing with real estate, crypto, any kind of asset class. So it's really, you can choose a certain asset class, but then it really comes down to deal by deal or investment by investment kind of specific nuances. And one thing I think that a lot of people don't, also focus on is that the market has kind of a big determining factor in how that investment performs. Can you kind of walk through how market volatility can affect different investment types?
Yeah, absolutely. So I think, a really good example is if you think back in the modern era to the most volatile time for most equities, what happened and what was the path back like? You look back to 2008, the great financial crisis. 2008, the great financial crisis. During 2008, if you're in traditional equities, and I remember this vividly from personal experience, what was several $100,000 in traditional equities in 2009 was worth like 50 or 60K, like gut punch, right? You go to sleep one day, you wake up, your portfolio is worth, a quarter of what it was before, or in some cases more. You also had scandals like Enron during that time that, created huge losses from bad actor type things. Now, when you compare asset classes during that time, if you were in the stock market versus you were in real estate had lost a lot of value as well. In any case, I think what savvy people did in 2008, 2009, and 2011, when all of that adversity was hitting all of these different markets, the people that had liquidity bought and made fortunes. So I think that's the piece to remember when you're looking at this and you're looking at worst case scenario. A lot of people are dreading what happens if 2008 happens again. 2008 happens again and you have liquidity, like you just hit the lottery. But if you were in traditional equities versus real estate took a little bit longer to rebound from something like that, but then rebounded a lot stronger late, like further on. So I would say in something like that, the base safest thing is typically going to be your treasury bonds. A lot of people held gold. You saw gold prices shoot through the roof and never really go back down. Problem is, like, how do you liquidate things like that? So all things to kind of keep in mind when building out the portfolio.
Yeah. And I like that you touched on liquidity too, because that's also really important investment. The more liquidity that you have, kind of the more nimble or the more kind of agile you can be. So like when you have, call it stocks or bonds or any kind of asset that could potentially, produce cash flow, the more cash flow you have, the greater accessibility you have when if things do go south, right? Like to your 2008 example, those that had liquidity could buy houses at pennies on the dollar, whereas those that didn't have liquidity were stuck pretty much selling their entire portfolio, right?
Yeah. And like sometimes, people that didn't have liquidity then, like say you were in a real estate multifamily deal like we do at Viking, and you were in it in 2008, your cash flow probably stopped immediately. And if you were stuck in that deal, you really couldn't exit then, which would have been a mistake to exit then anyway. But if you were in the stock market and you saw your portfolio go from 300K down to 75, there are a lot of people out there that sold then.
Mhm.
And that was a huge mistake. If they would have held on for 4 or 5 years, they would have regained most of that, and what they would have lost is time. So understanding how to use liquidity, when to exit investments, and really just how to position yourself is one part of your portfolio that a lot of people don't include as part of their portfolio is cash reserves. So if you have $10 million and you take 8 million of that and you put it into various investments that are on different areas of the risk spectrum and reward spectrum, and you have $2 million in cash, you're well capitalized to where you can use that cash to solve a problem, or you can use that cash, more importantly, to take advantage of a situation if things would get really adverse.
Yep, 100%. That's kind of why I like multifamily too, because it offers cash flow and appreciation, which not a lot of asset classes do both simultaneously, and tax benefits that are in there. Like it makes a whole lot of sense. It's kind of a nice segue into our next kind of segment. So we've talked about being agile, being able to kind of pivot quickly. Can you talk a little bit about diversification, what it is, why it's important, and kind of what the effect it can have on your overall investment portfolio?
Yeah, absolutely. And diversification is such a key topic when you're talking about investing. And it can get so granular. Just broadly in your investment portfolio, you want to diversify by having traditional equities, alternatives, gold, cash reserves, things of that nature. But then in each one of those subsections, you can create diversity as well. If you invest with Viking and you invested across 10 of our deals, you might be invested in Texas, you might be invested in Georgia, you might be invested in Indiana. The chances of some catastrophic thing, that affects the property happening in each one of those places you're invested in, the risk goes down. Now, if something affects all of multifamily, but you also have invested in retail and you've invested in hospitality and you've invested in triple net leases, then you have even further diversification. And that's just in real estate. Same
Mhm.
thing happens in the stock market. If you are only in blue chips, but then you're also in some aggressive tech stocks and you're also in some other things, all of that offers diversification. And the goal is to reduce your downside risk to where not one thing can take you down and you're able to stay, profitable in hard times. With real estate, the specific example I'd use is two major real estate sectors have been impacted by technology mainly. You have hospitality, which the introduction of Vrbo and Airbnb has massively cut into hospitality sales. And you had COVID that made it impossible for a lot of hospitality and restaurants and things to really operate. If you were only in that sector, COVID was super hard. Retail, COVID technologically affected that in a different way. People got comfortable working from home. Office space and retail suffered. So all of these areas, like that is why multifamily became, the belle of the ball. Like if you followed the smart money from 2000 and probably 2000 to 2012, 2013, most people would have said, put your money in office. That's where your money's safest because these people sign 10, 15-year leases and they're not going to, go back on these leases because it would be too costly. But when you have zero cash flow, nobody's going to the office because there's a government mandate. Multifamily's over here performing really well because people still need shelter and they have to pay their rent even though they can't afford it. And the office folks are just saying like, I can't go there. I'm gonna, take it back. Here are the keys.
Mhm.
Come after me in court. I can't pay. So having diversification is probably the most important thing when building your portfolio. And it's like I said, diversifying in different risk reward scenarios, different asset classes, and specifically just a broad sense of what your goal is in the end. Are you looking for cash flow? Or are you looking to, get hyper returns without much of an emphasis on cash flow?
Yeah. Yeah. Ultimately, it's about, limiting the downside and enhancing your upside. And there's different kind of, as you said, there's different kind of levels to diversification, right? You can have kind of broadly across different asset classes. You can invest in gold and stocks and real estate and, venture capital. Then within each of those asset classes, you can diversify across different, specific assets. So for example, if you choose, real estate out of, let's say you invest in bonds and you invest in some stocks, and then you also have real estate. Within real estate, you can invest in a multitude of different types of real estate: retail, office, industrial, multifamily. From there, you can diversify across different markets, or you can diversify across different sponsorship groups, right? So there's different levels of diversification, all with the kind of intention that you don't want to put all your eggs in one basket, right? There can be tremendous upside by doing so, but also tremendous downside. And the whole point of investing is to really limit the risk as much as possible and enhance your reward. But Chris, do you think there's such a thing as too much diversification where you kind of spread yourself too thin, or you think that any kind of diversification is a good thing?
Yeah, absolutely. And it's not so much that you're spreading yourself too thin, but blind diversification where you're just investing in everything that comes along is, a fool's errand. So you want to pick strategically. So everything that you do when it comes to building a portfolio and to choosing your investments should have an emphasis on intention. Okay, I understand multifamily. I have learned the ins and outs of this. I understand what could go wrong. I think this is a really safe asset class. I'm going to go into this asset class now. Okay. You're not going to just invest in the next hotel deal that comes along because you want something different than multifamily, especially right now. So maybe a case for investing in retail or hospitality might right now because, okay, like I think this is going to rebound. So you're crafting a narrative of how you want the diversification to help you based off of what you believe is going to happen in the future. So if you believe that AI is going to change the world, then with the portion of your more risky bets that you make, you should allocate some money in your investment portfolio to bet on some early stage AI companies or companies that you think are going to have market share in there. Don't put your entire nest egg into an AI stock that may or may not perform. But this is how the really, wealthy and strategic folks are putting most of their money goes into, like you mentioned earlier, Nathan, capital preservation. And then they'll take some really, really targeted swings of the bat when they feel like they have a little bit of extra information or they understand something a little bit better. And they'll pair that with, a pref equity placement of $10 million where they're guaranteed to get a 12 pref. And then
Yep.
maybe it's okay, I'm going to put 500K in this that's more, even if I lose that 500K, like I'm protected by this. I feel like this really could work out, and maybe that 500K goes 10x. That's really the game that most folks are playing once they get to a certain level.
Yep. Yeah, I was talking with a few different investors, and they're saying that they have a portion of their portfolio allocated towards kind of not fun investments, but more so kind of experimental investments, where they kind of have the majority of their portfolio locked in. They know kind of what returns it's projected to produce. They understand why they're investing in that kind of cohort, and they have 5-10% of not play money, but more kind of experimental money. They say, hey, if I lose this money and it's a huge risk, right? Nature of the game, they're fine losing that in the money. But that's the potential of even finding 1 out of 10 experiments that actually work out. And you, as you said, you kind of get in early in the game, you can have really tremendous upside. And it's the same thing with I talking with our director of marketing. Same thing. What happens in marketing, right? You test a lot of different narratives and graphics and see what sticks, see what works, and then that's where you kind of pour in the majority of your money. Same thing with investments.
Yeah, and it's just like, how they tell us here at Viking, like when we're managing people, like trust and verify, right? So like say
Mhm.
you're somebody that really believes in Bitcoin. And when Bitcoin got hot, you were like, okay, dump your money into Bitcoin. This is going to be huge. For a little while there, you made a ton of money. And then there was a little bit of, bad actor stuff happening, a dip. And a lot of people, if you talk, like I talk to investors all the time, a lot of people are like, oh man, I'll never invest in Bitcoin again. I got fooled. It went up, it went down. I lost a bunch of money. I'm going to put my money in real estate. And I tell them, I was like, not so fast. I was like, look, do you believe in the fundamentals of Bitcoin? Like, if you do, then there's an argument to be made that you should invest now while it's at the bottom because it's probably going to go back up. So I think that's where the trust your gut portion of investing needs to make sense. Like, if you believe in multifamily, you're probably the person that says, okay, the fundamentals are there. There's a shortage of supply. There is a human need for shelter, and we can't build this stuff any cheaper than we can buy it for. So those fundamentals tell you that if you buy multifamily and you're strategic and you do your research and you do the right thing, more times than not, you're going to make money buying multifamily.
Yep.
Now, if you're looking at something and you truly believe the fundamentals are there, then when you hit the dip and the blood's in the streets, like that's when you should pour in. Don't pour all of your money in, but like take a calculated risk. And that's what it's all about is like understanding the cycles, understanding, like don't look back 5 years, look back 30 years. 40 years, understand like how the Fed operates, understand what interest rates do to all of the markets. And then I can't emphasize this enough. And one of the guys that I used to work for before is writing a book on it, like really, really take into account technological risk. And he always used an example of like a taxi medallion. Like in 2000 and something, taxi medallions were like worth hundreds of thousands of dollars. It was like the only way for you to get from point A to point B without your own personal vehicle. And then all of a sudden, Uber came along and taxi medallions were worth nothing. So understanding where technology is going and how that's going to affect real estate, how that's going to affect the products that you use every day, the companies that you're investing in, I feel like that's something that's very commonly overlooked.
Yep. 100%. I remember a conversation with my brother when he was talking about Bitcoin, and he's like, "Man, there's this thing called Bitcoin, and it's only $50 for one coin." And I was like, "Man, if I knew what I knew back then, I would have bought a whole kind of Bitcoin by then."
There was a time when Bitcoin sounded ridiculous. You're like, what do you mean you can mine it on your computer? That'll never catch on.
Yeah. Yeah.
And now, like, if you held on to five or six, Bitcoin originally, and you had like a solid state drive with a few Bitcoin on it, it's life changing.
Yep.
So 100% completely
Yeah.
agree.
And timing is important too, right? Like the timing of investments aren't always up and to the right, and there is volatility in a lot of different asset classes. Can you kind of paint a picture of, hey, these are kind of the group that are seen traditionally as kind of more safer investments, And these are, another group that are seen as more kind of volatile and a little bit more higher risk.
Yeah, so with traditional equities and most alternatives, the prevailing theory is that US Treasury bonds are the gold standard for something that isn't gold, that's an investment that is the safest. So a lot of things are tied to where the 10-year treasury is, where short-term treasuries are. And the reason for that is because never in history has the US defaulted on a treasury bond. So you're basically saying that I'm safe by investing in this because I don't believe that the US government is going to fail and default on one of these bonds. Then you look at things that are more, I think a lot of stuff in tech when it's early stage tends to be riskier. Like 1 in 10 or 20 companies might really take off. But if you hit on that, 1 in 20, then maybe your small investment turns into a huge investment. I think that's kind of the riskier stuff. And then all the stuff in between is, you're like, is it riskier to invest in Amazon or is it riskier to invest in something like ExxonMobil? ExxonMobil has been around longer. They have more of a track record, but Amazon, you look at those companies today and you're like, okay, one's in the gas industry and we're hyper moving towards trying to make gasoline obsolete. And one of them is, a conglomerate when it comes to, media and logistics and the future. So I'd probably put my money in Amazon and not put the money in Exxon. But those are the types of things that you're trying to ask yourself. And then, especially publicly traded companies, there's a lot of information. Like you can research these companies, you can see what they've done historically, and you can try to pinpoint which ones are going to have adverse futures and which ones could go to the moon if certain things go right.
Yep. I think you also have to know when to kind of pull out and take your profit too, right? Because there's a time where blockbusters seem like an amazing investment. They're growing, they're opening, stores all over the nation, and now it's like a ghost town. You can hardly find one, right? I think there's maybe one remaining in the entire nation. And so, yeah, go for it.
The reason that I don't personally love traditional equities when it comes to, stocks and things like that is because the value isn't always based on fundamentals. It should be, but a lot of times, like you see, like what happened with like GameStop and some of those stocks where it was like human actions that aren't based on logical thought cause a stock to go up or down. It's like whether something's worth what someone's willing to pay. So if people are buying something up, it could raise the price for a time. Whereas, and multifamily, I think you know this better than anyone, Nathan. Like there was a time, a few years ago where multifamily, they finally found that point where the fundamentals stopped making sense. People were paying so much, but it was because the competition was so great. It wasn't because the deals made sense from a fundamental standpoint.
Yep.
And that's when you see that kind of happening, that's when you should look at it and say, okay, am I taking a bigger risk now because everyone else is doing it?
Yeah. Which speaks to kind of what you said, earlier on was know what you're investing in, right? Know when you kind of reach that point where the value is inflated beyond kind of what the intrinsic value of that asset is. And you only know that by doing research and kind of being in the game, right?
And tracking what the people that are bigger investors in you in that area are doing, which a lot of time is common knowledge. Like when you see, institutions that are, freezing and not doing anything, ask yourself why, try to figure out why. Sometimes it creates an opportunity. Like I feel like in multifamily right now, it's the investment committees they have to go through and they're literally waiting for a certain benchmark. So there's a time right now where our thought at Viking is this is the time to buy before the institutions come back. We're getting the best cap rates we've seen. We're getting the best debt we've seen recently. And these yields make a ton of sense. When the institutions come back, everything's going to be more expensive because interest rates are going to come down and there's going to be more competition. But if you're looking at like with that GameStop scenario, the stock's going up and the people that own the company are selling all their stock. Like red flag.
Yeah. Yeah. And zig or zag, you kind of have to know why you are zigging when others zagging. Right? There might be a very valid reason for why everybody's selling that stock, right? But if you believe in the kind of long-term, intrinsic value of that asset and you're able to weather kind of the short-term volatility or kind of uncertainty, then I think that's really where deals are made. Those that take the risk when others are kind of just following the masses.
Yeah.
Do you have, 3 tips for investors that are really kind of concerned about volatility?
Yeah, I would say if you're an investor who experienced a lot of adversity over the last couple of years, whether it be Bitcoin or the stock market, like really look at what you're investing in and if this is an opportunity or if your fear was justified and it's just something you shouldn't have been investing in. I think coming up with the ability to pivot quickly and to trust your gut is essential in really hitting your stride investing. What did you want several tips?
Sure. Give me one more before we wrap up.
Yeah, so I'd say the other thing is to really take a hard look at real estate and what the Fed's doing. Because I think that we're in this time where interest rates are high. They're still high relative to where they have been, and pricing's still high, and you can get value. So it's whether are you looking to buy a house in the next couple of years? Are you looking to invest in commercial real estate? Remember that, you're not necessarily, you're marrying your basis, not the rate. So if you can take a time where it's easy, you can get the best terms, you can get the best deal, you can get the best basis, and then refinance in a few years, I think that makes a ton of sense right now.
Yep, absolutely. Well, Chris, I know you're on the calls all day with these investors. I appreciate you taking the time to step away, share some knowledge. For those of you who have more questions about real estate investing or volatility, how can they get a hold of you?
Yeah, C. Parinello at VikingCapLLC.com. Reach out to the investor relations team. Anyone that wants to sit down with me and kind of talk about what they have going on, get any feedback from me. I do this with folks as, just as a friend, just as I build relationships with folks. I'm happy to spend time going through and chatting about what you have going on.
Awesome. Appreciate it, Chris. We'll see you next time.
Thank you.
If you like this podcast, please hit subscribe or a thumbs up, and we'll see you next time.